Both markets right there. Let's bring in our next guest. Francis Tan is Chief Strategist Asia at Indo-Suez Wealth Management, joining us live around the desk here at the SGX. Francis, great to see you. Always a pleasure having you on the show. I want to take a look back. We haven't actually spent enough time doing it, I don't think, this morning, at the jobs report, the payrolls, which dropped on Friday, right? What do you make of those numbers, and are they consistent with a U.S. labor market which is starting to fray around the edges?
Well, certainly, if we look at the earlier, before the jobs data were out last week, we saw the unemployment claims, and that shot up higher. But of course, the key reason to that was because it was weather effects from January and February that saw quite a big jump in the unemployment claims. But however, 151,000 of NFP, I think that's quite a respectable number, although we must admit that it has been slowing down over the last 1 year. In fact, the slight increase in the unemployment rate as well certainly also goes to show that we are not going to see an unemployment rate in the 3.5 to 3.6% anymore. And that was what we saw 1 to 2 years ago, right? So basically, what we are seeing in the US, as much as what many people are thinking, there's going to be hyperinflation in the US because of tariff, I don't think so. Because at the end of the day, we must know that the CPI, the baskets of the CPI, a larger part of it, around 63%, are services-based. The other parts, 20%, that's goods-based. So if you're going to tariff 10%, 25%, what have you, on goods, is not going to affect with so much weight on the overall consumer basket in the US.
That's a good point there. But having said that, though, I mean, the CPI dropping on Wednesday is still going to be important to watch, right?
Oh, yeah, certainly. Yeah. The CPI numbers does have their month-to-month gyration. Some months it's 2.9, suddenly it's 3.0 on the headline basis. Yeah. But I think it's okay. More importantly, we need to look at the average. And the average will still be slowing down. We have a little economic model within the bank, and it shows that we are likely to see more disinflation going further. So now the headline CPI, I mean, if you can look at PCE, it's all similar. It's going to trend lower as we approach the second half of this year.
So if disinflation is intact, if it's happening, continuing to happen in the U.S., it seems like it would give the U.S. Central Bank, the Fed, more room to lower rates, right?
Certainly.
Now, with all the Trump tariff uncertainty, et cetera, folks are talking about a start not in September, but maybe earlier, June. And people are talking about potentially 3 cuts this year. Is that what you're looking for?
Well, the market's looking at 2+ cuts to even 3 cuts. We are still sticking to our 2 cuts, mainly because the tariff do have some impact on the overall consumer inflation, but the impact is not as large as what the market is pricing in. So I think for the whole of 2025, we are expecting 2 rate cuts right now.
2 rate cuts. What's that going to do with the dollar?
Well, the dollar right now is on... I mean, technically, if you do a lot more rate cuts, that is beyond market's expectations, the dollar will weaken. The current weakening of the dollar is mainly due to the scare or the news from tariff. As we know, for the country that starts tariffing the other importing countries, usually your currency will move lower. And in the economics textbook, it's called FX as an automatic stabilizer. FX will move accordingly. I mean, if it's a free market forces, according to the country that has a tariff. So for instance, if you look back in 2018, when Trump levied tariffs on China, during that time, the renminbi did depreciate around 12% in terms of the drawdown against the US dollar. So taking away and having a buffer, taking away the majority of the hit of the tariff. So other than the FX depreciating to take away the hit, we do have the wholesalers, the factories in China cutting a little bit in terms of their pricing. So they are trying to buffer a little bit, having a lower profit margin, but it's okay. At the end of the day, they want to do a volume business. They still want to send things to the US, right?
So here, but that's where it becomes a problem, right? Because China has been accused of exporting its overcapacity, right? And we just had data out over the weekend. It's not just wholesale factory gate prices, which are in deflation. Now, even sticker prices, retail prices in China are also negative.
There's indeed too much capacity. And when the supply curve shifts to the right, too much capacity, prices will drop. And that's exactly why China has been in this deflationary, I will not say it's a spiral, but deflationary environment over the last 1+ to 2 years. Well, of course, for a country that has excess capacity, because it's really competitive, everyone trying to get the prices lower, right? You do see such requirement or needs to try to sell to your consumers or to the wholesalers. And that's why China has always been pointed out, saying that you're trying to export deflation to the world. But that's not true at the end of the day. Why did China have so much factories in the first place? It's because the rest of the world found that their labor costs, everything is too high to produce there, that the comparative advantage of China 20, 30 years ago make China a lot more attractive to have factories over there.
Yeah, indeed. The issue of the renminbi, managed currency, right? We had a guest earlier on saying, look, out of the NPC, it seemed clear to him at least that they are probably not considering or looking at a big one-off devaluation of the renminbi. It's happened before, right? Yeah. Caught a lot of people off guard, and we saw the market reaction was pretty negative, right? It would be probably unwelcome this time around. Can we totally rule that out? Another big one-off devaluation?
Well, certainly I believe the Chinese policymakers want a stable currency. They do not want to be shown to the world as using the renminbi as yet another a weapon in the whole entire international trade. I mean, right now China is being pointed fingers at for sending out excess capacity to the world. Yeah. The last thing that they want to be pointed finger is that, oh, you are devaluing your renminbi.
Currency manipulator.
Exactly.
Yeah.
I believe the policymakers in China want to really buff up the entire domestic economy and deal less now or trifle less now with the other countries, including the US. So for that, FX, as I mentioned, is an automatic stabilizer. By that, the renminbi will depreciate automatically without the policymakers signaling any devaluation potential or strategies.
All right, but it is a managed currency, and they're going to manage it so that there is not a big one-off devaluation,
exactly.
Right?
Yep.
Softer but no crash, is what you're saying.
Yes, that's right. I don't think so.
Okay, all right, Francis, stay right there. A lot more to talk to you about. We'll continue with Francis Tan coming up in just a short while. Meantime, Francis Tan, Indo-Suez Wealth Management, live around the desk here at the SGX. When you have conversations with clients, right? I'm sure one of the top questions that they ask you is, look, Francis, tariffs, what do I do? What should I do? And in terms of your sort of wealth advisory, what do you tell them? Because right now, a lot of companies, a lot of high net worth individuals are sort of paralyzed. They don't know what to do.
Indeed, especially if they do hold on to companies that are affected by the tariff outright. Yeah. I mean, you're just mentioning about the steel makers in Korea, and if you hold on to them, that's it, right? You're going to see quite a big drawdown and perhaps even more uncertainty going ahead. I think that's the key thing of basic tenets of finance is diversification. That's number one. Yeah. And you're not going to put all your eggs in the steelmaker's basket for sure. Yeah. So diversification is certainly one, and that doesn't mean just across sectors. If you're in the equities, that's also across asset classes. So fixed income, we have in fact we are still overweight in our fixed income segment for our clients, and that provides in fact quite a nice safety buffer for our clients' overall portfolio allocation, especially when Trump got inaugurated as a president, and we do see a lot of news that's coming up, and suddenly there's a tariff, and suddenly they say, okay, let me think about it. You know, all this gyration or what Jerome Powell said about the noises, these are very much out there. Gyrates the stock markets, but those with a nice buffer of fixed income, I think they are sailing through.
Are you telling them to go long duration though?
Okay, longer duration right now is a little bit hard now, mainly because we are more on the neutral side on duration, mainly because the market is still gyrating between, is the US going to see inflation? Is the Fed not going to cut at all this year? And that's why it may not be necessarily good to long duration. But whenever 10-year yields hit around 4.7, 4.8, we go slightly longer a bit.
Yeah. I mean, it's hard to ignore, right? 4.8 yield. I get that. Obviously, another hedge, another diversifier is gold. I'm sure you like that.
Gold certainly is still in the cards right now, mainly because of a few things. Number one, uncertainty. Gold is a hedge against uncertainty. Number two, the potential inflation that the US is going to see, which I don't really think so. Gold is certainly also a hedge against that. More importantly, gold right now is a hedge against dollarization. In fact, the world is moving away slowly, little by little every time, right? And what that means is that gold seems to be the alternate currency that everyone accepts other than the US dollar. So we do see some flows over there.
Do you get a lot of questions on, in terms of diversification, do you get a lot of questions from clients on crypto, whether or not they should be exposed to crypto? Because, I mean, this whole idea of regulation, right? Europe has actually moved far ahead and faster than the US in terms of regulation on crypto, no?
Well, certainly, many clients always ask about that because they have met someone who has made some riches in crypto, and they're saying, why don't I have that into my portfolio? portfolio. Now, because that goes back to the basic of, let's say, crypto or even Bitcoin as part of crypto, first of all, the volatility is pretty high. And when the volatility and the potential drawdown can be quite high, then we want to be naturally a little bit be careful of this asset class. Now, certainly there's no harm for clients if they want to, on their own, to put some crypto into their overall portfolio, but we do not advise with that as well.
Certainly not a higher weighting than, let's say, gold, right?
That's true. Yeah. Gold is part of the civilization since we started. Gold has been there. So.
Here's the question, right? This is always very telling, right? On average, right? What kind of levels are you recommending clients in terms of how much cash they should be holding?
Right now, the cash level should anything between 10 to 15%.
Really?
That's
pretty
still
high, right?
Yes, we are still very much. The reason is mainly because of the sell-off we are seeing in the US right now, and that is on the back of the news of more tariff coming up against the world, right? And especially after DeepSeek, we do see some potential overvaluation in US tech. That's why we have been asking clients to put more to pair up some profits, to put more into fixed income or even raise some cash right now.
Okay. The other part, which is becoming interesting, is private markets.
Oh, yes.
Right? Before, I think, November, before the elections, before Trump won, etc., folks are thinking, okay, we've got this whole inflation thing beat. Fed's going to have our back. Fed put is back. They're going to cut. And after a tough couple of years for private markets, VCPE, anything in there, it's going to be good times again.
Well, private markets is an important part of it's a diversifier of any portfolio, so that's important. The only difference is how much percent you want to have a weight, and that really depends on your investment horizon. If your investment horizon is long enough, we do recommend a higher percentage of your portfolio in private markets. Private markets suffered quite a little bit, especially when interest rates are high, but now it's coming off a little bit. It's like how REITs has been suffering as well, right? Now it's coming off a bit. I think the private market, especially for lots of clients or investors or people around me who doesn't really know much about private markets or who have zero allocation to private markets, it is really time to look for in private markets. It is indeed a good hedge to any portfolio. And
the thing is, I mean, if you're right, I mean, your personal view, and I assume this is the house view at Indus as well, is that deflation is intact in the U.S. The Fed is going to be able to cut rates, so therefore the put will be there, and that should be positive and supportive for private markets.
Yes, certainly. I believe right now we are, as we have mentioned before, we are in the autumn part of this business cycle, and autumn means that we will continue to see this inflation in the developed markets, including coming up in emerging markets as well, China aside, of course, right? That will continue to mean that we need to seek such an opportunity to have increase our exposure to fixed income and also private markets.
Okay. All right, Francis, hold that thought. A lot more to talk to you about. We'll continue with Francis Tan from Indo-Suez Wealth Management coming up in just a bit. As we tail into a break, though, our guest host, Francis Tan from Indo-Suez Wealth Management, is still with us live here as well. Tuan, great to see you. Good morning and a pleasure having you on the show. The attraction of Vietnam and exposure to Vietnam, give me a key metric, which is always very important for foreign investors. ROE, where is it right now?
Pardon?
ROE?
ROE.
Yes, ROE.
ROE is about
return on equity.
It's about 15%.
15.
Yeah.
Wow, that's sounding good. And okay, two other key metrics: valuations. How's that looking, and how fast are earnings growing?
Vietnam is still officially classified as a frontier market, so it has been trading as a discount to regional emerging market peers. Valuation is around 10 to 11 times price to earning on a forward basis, while the growth this year is expected to be at mid-teen.
Wow, okay.
Very interesting. One foreign fund manager that I spoke to out in Vietnam actually highlighted, despite the fact that a lot of these foreign funds are leaving Vietnam, the investor base, the domestic investor base, has more than picked up the slack, and we saw it there, 30% up actually since 2023. Can you talk to us about how the domestic investor base in Vietnam has developed and why they've gotten so strong over the last 30 months, for instance?
So there are two key drivers behind that trend. I think the first being that it was only 2 years ago that Vietnam GDP per capita have crossed the threshold of middle income by the World Bank standard, and that's around $4,500 US. And once we have always identified that was the threshold where once you've crossed it, there will be accelerating demand for financial investment from the household in Vietnam. Number two, since August 2020, the government of Vietnam have allowed e-KYC in Vietnam, and that means that investor from anywhere in the countries can open a stock account and a bank account that go with it. And so what we've seen since 2020 is that over the last 4 years, we have opened twice the amount of stock account investment compared to the previous 20 years of the stock market.
Oh, thanks, Tuan. I mean, I've been looking at the ASEAN economies in quite a strong way, big way, and especially right now when we look at tariff, and Vietnam is again on the spotlight in the world as being the country whereby over the last couple of years, the Chinese manufacturers shifting goods over in Vietnam and exporting back into to the US again. That's round tripping. But of course, the positive thing is that the Chinese factories are also now being based in Vietnam and producing really onshore. Now, do you think this wave of Chinese companies, Chinese investments, FDIs, and even wealth coming into Vietnam will really help to boost up the overall equity sentiments in Vietnam for the rest of the world?
We do think so. I think that's certainly our belief. I think Vietnam, the government of Vietnam over the last 15 years have really tried to build Vietnam as a platform for attracting manufacturing. It's not just the Chinese manufacturers coming in Vietnam over the last 5 years. Over the last 15 years, we've seen major manufacturers such as Samsung, LGs, and most recently the Apple vendors have also came to Vietnam. Lego, interestingly, chose Vietnam as the country to build its first carbon neutral factories in the world. And so we think that is a trend that is going to continue regardless of what happens. The government have beyond certain tick boxes such as relatively competitive labor costs, high literacy rate of the labor forces, and high labor participation. The government of Vietnam also positioned Vietnam in terms of trade as a friend of everyone. So Vietnam has one of the biggest free trade agreement collections in the world. It is, along with Singapore, only one of 2 countries in ASEAN that have a free trade agreement with the European Union. And so we believe that the FDI trend coming into Vietnam is going to continue. And certainly when you have a lot of high tech and industrial manufacturing coming to the countries, it helps build up the wealth of the people, and certainly that will help boost GDP, and ultimately hopefully help the equity market as well.
Tuan, is it immune though to reciprocal tariffs?
I think the word reciprocal is probably the most used word over the last 2 months. However, Vietnam approach, I think over the last 2 months, we've seen a stark difference between the Vietnamese government approach comparing to the other nations. I think Vietnam is seeking to build and maintain, according to the Trade Minister, harmonious and sustainable trade relationship with the U.S. So he was actually in the U.S. last week, and that was precisely his intention, which is to expand on the trade relationship rather than seeking to impose reciprocal tariff. Vietnam, the U.S. certainly is a very important trade partner to Vietnam. So I think the government of Vietnam understands very well there is a large deficit to the U.S. In terms of trade. So Vietnam is the number 3 on the ranking, behind only China and Mexico. And so Vietnam government have already identified a number of sectors that it can encourage import from the U.S., such as agriculture, energies, and most recently airplanes.
Right. Yeah. How optimistic is Vietnam that this year, maybe next year, will be the year when you are upgraded to emerging market status? And is it still important, given how strong the growth has been for the domestic retail base, to support the outlook and the thesis for Vietnamese stocks and equities?
So we have looked at the emerging market upgrade for many years now, and we do believe that the next 12 to 18 months is probably most likely going to be the best chance for Vietnam to be upgraded. So last year, the SSC, the State Security Commissions, have implemented a number of reform in order to address some of the key issues that was highlighted by some of the indices providers. So we believe that by working closely with the FTSE, there is a very decent chance that Vietnam will be upgraded to secondary emerging market status this year.
First before the MSCI, or you
We
think
believe that the
door
FTSE
for
will
the
come
FTSE will
first.
open first?
We believe that the door to the FTSE will be open first.
I see.
I think there will be more work to be done with the MSCI, and hopefully that will come soon after.
All right. And just quickly, I guess the outlook now, if there is one sector that seems to be a bit of a drag or an uncertainty for Vietnam, it's the property sector. Has the worst perhaps lifted? Have we seen the worst? Have it bottomed out, as some would say at the moment, for property stocks?
We certainly hope so, and we certainly see the sign that the worst of the property sector has been over. I think the government over the last 12 months have identified that the warming up, or rather the comeback of the property sector is needed for the economy to do well. And so over the last 12 months, they have worked very hard with provincial level as well as various ministries in order to resolve some of the legal deadlock. There have been various task forces being set up in order to address some of the legal deadlock in the sectors. And we've seen real progress over the last 3 to 6 months on that sense. So this year, actually last year, there was a material tick up in the number of transactions, property transactions in Vietnam. And we further see that improving this year.
Very interesting.
Okay, Tuan, listen, we got to leave it there. Fantastic talking to you. Thank you so much for dropping by. Come see us again very soon.
Thank you for having me today.
Oh, pleasure is ours. Tuan Vui there from Dragon Capital, and Francis Tan, Indo-Suez Wealth Management, has been with us for this whole hour of this morning, and JP Ong, my great colleague as well.